Good afternoon, ladies and gentlemen, and welcome to the Urban Logistics REIT PLC interim results investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged. They can be submitted at any time via the Q&A tab that's just situated on the right-hand corner of your screen. Please just simply type in your questions and press send. All questions will be reviewed with responses published on the Investor Meet Company platform where it is appropriate to do so. Before we begin, we would just like to submit the following poll, and if you could give that your kind attention, I'm sure the company would be most grateful. And I would now like to hand you over to the team from Urban Logistics REIT PLC. Justin, good afternoon, sir.
Good afternoon, ladies and gentlemen. Thank you for joining us for an update on our interim results as of 30th of September 2024. For those of you joining us for the first time or seeing us present for the first time, my name is Justin Upton. I'm the CIO of the Investment Advisor to the REIT, and I'm joined by Jamie Waldegrave, COO and CFO of the Investment Advisor. Today we're going to talk to you about the interim results and where we see potentially the market going, an update on our debt refinance from August this year, our investment into the market from some additional drawn down debt, and where we effectively see the urban logistics market moving. So I'll take the first slide. Those of you who are unfamiliar with us as a strategy, we are a purely focused single-let last mile logistics REIT. We have approximately 1.15 billion of assets in 133 separate properties. Our typical asset size is focused on 20,000 to 150,000 square feet. And we believe as managers that the last mile logistics is the most supply constrained area of the logistics market and thus the most open to rental growth going forward. The key buckets of our strategy remain core assets, active asset management and development. Ultimately, those three buckets determine where the performance goes and where we really drive returns for our own shareholders. Now, initially setting the strategy out, we are an active asset manager. We are a value add core plus play. So most of the work, the asset management we undertake, sits in that active asset management bucket. The strategy today, and those of us who saw present on our annual results back in June, the buckets as we sit are core assets. Now these are typically longer income assets where we've undertaken the asset management, extended leases, spent capital expenditure and improved ESG. Therefore, effectively the byproduct of our asset management. They typically have longer weighted unexpired lease terms of around 10.3 years, strong tenant covenants, over 99% rent collection, and good ESG. So 80% of that portfolio has an EPC rating of A to B. That today sits around 48% of the portfolio, and that is down from the 51% we presented in March. The reason for that being, when we talked to you in March, our view was that we wanted to rotate the core assets away and more towards active asset management. As an active asset manager in a normal market, we would target around 60 to 65% of the portfolio in this middle bucket of active asset management. This is where we really drive the alpha of the portfolio, and we would have somewhere between 30 and maybe 35% in core assets. Turning to the active asset management bucket, this is where we really see the opportunity to increase rents, to add value. As you can see from the screen, the ERV represents a 43% uplift versus the current contracted rent. So this is really where the assets are sitting with big reversions, rent reviews, lease renewals, and active asset management to undertake. The weighted unexpired lease term of 4.7 years is shorter. We want to capture that growth quicker. And there's the ability to improve ESG on the portfolio. At the moment, circa 45% is either A or B rated. And what we're trying to do here is improve ESG, spend money on the buildings to then move them across into that core asset bucket. So this portfolio is a key contributor of your total return. Today, it's sitting at around 51% of the portfolio, up from 48%. And the final strand is the developments. Ultimately, this is where we take development risk. Now today I've got no developments on the horizon or undertaking any. We pulled out of development approximately 2 years ago. Quite simply, it got too expensive. The market forgot how to price risk. Effectively, to give you an example, you could buy 10 years of DHL income for around 4%, or you could speculatively develop a vacant shed for 4.5%. So for a 50 basis point risk arbitrage, you didn't feel as though you were being recompensed for taking speculative risk. The 1% we currently hold today is land where we've either got planning permission and we're working up pre-lets, or it's additional land where we are trying to build effectively relationships with the tenants to take additional space. If we move on one slide. If I look at the tenant lineup of the portfolio, we've said this before, it very much is akin to big box. Our last mile logistics tenants are very much blue chip. One of the key components when we undertook the strategy and IPO'd in 2016 was the commonality of strong tenants. They're split into effectively three main buckets. You've got your effective production and manufacturing tenants like Volvo, Chemviron, third-party logistics and distribution, the DHLs, DPDs, FedExes of the world, and what we sort of call essential consumer goods, the likes of food, pharmaceuticals. One key feature of this strategy from day one is we refuse to touch fashion. With over 100 CVAs between 2014 and 2019 in fashion, it is an area that we see as quite fast and not the sort of long-term income growing investment that we as a business want to accommodate. Since IPO, we've had over 99% rent collection quarter on quarter. We use Dun & Bradstreet on our covenants. 94% of our covenants are rated low to moderate credit risk. So where do we see the landscape of actually urban logistics? Well, quite simply, supply constraints and continued ongoing demand has led to continued rental growth. Take up in 2024 is above that we saw in 2023. If you go back to 2023, the macro environment weighed quite heavily on a lot of FD's minds. The 10-year gilt had over 100 basis point spread over 12 months. It was very difficult for FDs to price expansion and the implications of the cost of that expansion. What we've seen in a more stable macro environment in 2024 is an increase in space take-up. In 2023, circa 18 million of space was taken up. For the first half of 2024, almost 17 million has already been taken up. So we anticipate year-on-year take-up increase. Now, on the other side of the graph, you'll see the levels of rental growth. Rental growth has reduced from probably the highs or double-digit highs we saw in 2020, 2021, post the pandemic. But what we're seeing going forward over the last sort of 12 months is decent rental growth. Sources such as Knight Frank and Savills are suggesting going forward, rental growth levels of between 3 and 5% at market level per annum over the next 5 years. So on a typical lease over a 5-year cycle, a landlord should be predicted to get around a 20% plus uplift on rent at each review cycle. Now, obviously, there will be a lot of regional variations, and certainly we're seeing that going forward. London at the moment is struggling a little bit. We have seen some incredibly high rent rises, some quite strong land prices being paid. And what we're now starting to see is a bit of an affordability question come into the market. If prime rents in Enfield are, say, £35 for a 100,000 square foot box, and yet you move across 25 miles to, say, Dunstable, where rents are £15 a foot for the same 100,000 square foot box, that is a cost differential on a box in excess of £1.5–2 million per annum, which has quite an impact upon ultimately an end user. I'm going to hand over to Jamie now to talk about why we see the portfolio actually positioned incredibly well to capture a lot of this reversion we see pregnant in the portfolio.
Thanks, Justin. So what we're looking at here is the reversion between where our valuers who come in as independent valuers every 6 months to put a market rent on each property in the portfolio on the right, that's at 80.1 million, and where the contracted rents sit on the left, and that's 63 million. And before we get into any detail, it's worth saying there is, between that contracted rent of 63 million and the market value of 80 million, there's a 27% reversion. And that reversion is the highest it's ever been in this portfolio. And that's important because it's that reversion that provides the platform for earnings growth at Urban Logistics. Now, there is 3 distinct areas of reversion we'd like to run through. The first is the vacancy at 8.1%. And we break that vacancy down to look at a couple of distinct types. That 8.1% is made up of 6.5 million of total ERV. Now, 1.8 million of that is under offer, which means that in the normal course of event, in the coming weeks and months, you'd expect to see that leased up as those lease contracts are signed. Next up is 2.8 million of ERV at assets where we acquired the asset with 12 months or less on the lease, i.e. we acquired an asset with a planned vacancy where we would then put in a new tenant at a higher rent, generate an increased rental income, as well as a significant capital uplift as you take a vacant or short-let property and put it on a long lease on it. You've got 0.9 million in the refurbishments category. This is where a tenant has come out of the building and we've taken the decision, rather than relet it immediately, to refurbish that building, add to the rental rate as well as the capital value of that building. This improves the actual fabric of the building. It also improves the ESG credibility of the building. Finally, there's 1 million of underlying vacancy, the normal churn you'd expect to see in this portfolio, where our asset managers are working to improve the covenants, the rental rates, and the fundamental asset quality. Now, this vacancy offers the fastest route to earnings growth because it's available to capture now. It's available for our leasing team to lease up and add significantly to top-line rental growth. Next up on reversion is 0.9 million in the rent reviews category. Now, if vacancy is the fastest route to rental growth, rent reviews are the most secure. We know the dates of those reviews, we know where the market is, and we know what that where those rents will be settled, and there's no opportunity for the tenant to leave at that point. Finally, we have our last section of opportunity within expiries, where we've got leases coming up to breaks or expiries. What's notable in this case is that there's very little in our contracted rent that is subject to expiry in the next 12 months, less than just under 2% of the entire contracted rent roll. It's also worth noting within those expiries and renewals that, of course, you're not guaranteed that the tenant will leave. We have a very, very high tenant retention rate, but we do have that opportunity and that risk. We add that lot together and what we get is an incredibly stable base to grow top line rent. There's a lot of opportunity and not a huge amount contractually at risk. And top line rent, of course, for us flows very neatly through to bottom line EPS because of the structure of our P&L. We have a very high net to gross ratio, and below that in the P&L, we've got very much fixed costs, a fixed advisory fee, fixed independent board, and as we'll come on to see, very much fixed debt costs. And that's where we see the opportunity for growth. The opportunity to add to top line revenue within the vacant assets alone is 1.4 pence. If you add in the opportunity within the occupied part of the portfolio, that goes up to 1.6 pence in a pence per share basis. And while we're talking pence per share, it's worth pausing and talking briefly about dividend, and we get questions about dividend cover, which is worth addressing here. So we have a dividend of 7.6p, 91% covered in the last financial year at 6.9p of earnings. Now, the results we're putting out today have earnings at 3.6 pence. For a crude run rate, therefore, you can double that to 7.2p for your run rate. And you can see the progress we've made against that dividend cover in this period. More importantly, perhaps, you can see that if you take us on a run rate of 7.2p and a dividend of 7.6, the reversion in this portfolio, 1.4 pence from the vacant assets available in the next 6 months, 0.2 pence from the occupied part of the portfolio available in the next 6 months, gives us that confidence that dividend cover itself is not a challenge for us. And in fact, in due course, we're talking, we hope, about dividend growth rather than cover. Of course, this whole graph is only looking at this financial year, really. The numbers we've been talking about, that 1.6p, is available within the next 6 months. There's a further 9.1 million available in future years, which we'd expect to be able to capture in the future. And the only point I'd make to that 9.1 million is that is at today's ERVs. As we'll come to talk about, our ERVs, or estimated rental values of those portfolios, have been growing significantly. And as Justin has said, we anticipate continued rental growth in the market, meaning by the time we come to capture that 1.9 million, it is in fact a higher number already. We're going to move on briefly just to touch on our ESG and our ESG commitments before we come on to the rest of the financials, because we think that is important. And we continue to focus on our ESG priorities. And we've got 60% of the portfolio is rated A, B in terms of EPCs. And it's really important to note that we've done that while operating the core business model that Justin's talked about. We buy stock that needs improvement, and Justin will talk about what he's bought in the period, but buying properties that have EPC well below a B, and selling stock that we've enacted our asset management plans, and therefore we're selling our EPCs at A and B. And so the way we make that work is through our asset management expertise to improve the EPCs of our buildings. So we have a very experienced asset management team. The model is fundamentally low capex, and we're also supported by the fact that our tenants, as Justin has said, typically larger businesses, share our ESG goals and invest their own money in our buildings. At a portfolio level, in ESG, our priorities is really around that net zero goal, and we've done significant work baselining an SBTi net zero target in line with the building sector pathway, and you'll continue to see us progress in that area. We'll come now to talk through the financials that we're releasing today. And if we look at the P&L side, we continue to make progress on growing our gross rental income up 3%, and that flows through to adjusted EPS up 3.2. And it's notable that the growth in rental income and growth in EPS has happened despite actually our vacancy creeping up to 8.1%, which is slightly higher than we'd like to see it. And the way that's happened is that constant cycle of rent reviews and reversion that's available to capture within the occupied part of the portfolio. For us, that vacancy rate really does give us a fast route to growth. On the balance sheet side, net assets is stable at 158p. That's down about a 1%. And the reason for a slight reduction in net asset value is really the costs associated with acquiring new properties. We acquire properties in September, and inevitably you have to pay stamp duty and legal costs on top of that, and that has a slight reduction in NAV because of that. I think it's worth actually noting that if we were to look at the NAV in terms of the replacement value of our properties, when the insurable value of the properties, we see that our current portfolio rebuild cost is significantly ahead of our net asset value today. On the balance sheet, in terms of debt, our loan to value is still very low at 33.2%. And as I've said, we're 100% fixed or hedged through to term. And we'll come to talk a little bit about the debt side and what we've been doing with the debt in the period. Now, going deeper into EPS growth, we can see that our growth from gross rental income has been strong, but somewhat offset by an increase in property operating costs. And this is what you'd expect to see with that higher vacancy rate that we've got in the portfolio today, higher property operating costs. The good news on that is as those properties let up, you would expect to see those costs fall away. And so when we talked earlier in the deck about a 1.4 pence per share increase available from vacant properties, in fact, the number's slightly higher than that because you take out the property operating costs at the same time. Admin expenses reduced. There's been a new advisory agreement entered into, which came with a significant reduction in costs to shareholders, while interest costs have marginally increased due to a small amount of unhedged debt pre our refinance and a greater quantum of debt post the refinance. And we'll come on to discuss that refinance in greater detail in a moment. Turning to our key driver of rental income, leasing activity. What we've seen is 1.2 million of additional rental income generated across the period, across 13 lease events. And as sort of Justin, I think, has alluded to, and maybe we'll talk more about, we have seen decisions on the leasing side take a little bit longer in the last 6 months. But that hasn't had any effect on the values that they've been settled at. So we've seen 21% like-for-like uplifts, which is, as Justin has mentioned, that's that 5-yearly cycle and the continued rental growth we've seen on that 5-yearly cycle of rent reviews and rent and lease lengths. We've, in fact, in this period, been significantly ahead of ERV. So ERV across the portfolio has grown very quickly. And in fact, we've then settled our lease events significantly ahead of ERV. And it's worth pausing for those who followed this presentation this time 12 months ago. This is quite a different situation to where we were 12 months ago, where actually our like-for-like rental uplift was 10%, strong, but quite a long way back from where we sit today. And actually, we settled these rent reviews just behind ERV 12 months ago. So again, that really speaks to the resurgence in the demand and the underlying demand for our properties. We talked about ERV growth, and you can see, again, the demand for our properties in the ERV growth that the valuers, independent valuers, have put on those properties. So in this 6-month period, they feel that the ERV, the rental values of our properties have moved on 3.5% in just 6 months, significantly ahead of market expectations. And that's really important because that drives the reversion and it underpins our future growth. ERV in the portfolio as a whole sits at 27%, and this is the highest level we've seen since IPO. What's really important when we look at that is, given our lease structure and our vacancy rate, nearly half of that is available to be captured within the next 6 months, which is conducive to really high top-line growth. And that's a similar story when we look at the expiry profile for our leases. What you can see on this graph on the left is that in the next 12 months, 2% of the contracted rent is subject to a potential expiry. And I say potential because we have a high renewal rate, so many of those tenants will look to stay in place. But there's very little contractually at risk on that expiry side. The graph on the right shows a very different story. 15% of our contracted rental income is subject to a rent review in the next 12 months. And that gives us, those two graphs together give us a really strong base to be able to grow top-line rental income. And I think it's important to touch there on the structure of our leases a little bit further. The majority of our leases have open market rent reviews, where we're able to fully capture that ERV growth we've just talked about. And that's crucial to be able to, for us to be able to deliver on the top line growth and the bottom line earnings growth. We'll turn now to the balance sheet and the recent refinancing that we announced in September. Now, for those who joined us 6 months ago to talk about the annual results, you may remember that at the start of the period, we had a debt maturing in August 25, and we signalled at that point that we were looking to refinance that. And in this period, we've done so. In doing so, we pushed our earliest maturity back from August 25 to August 27, with 2 one-year extensions options to push that back all the way to 29, if we'd like to. And we were able to take advantage of some very, as it turns out, optimistic expectations around interest rate cuts that drove the 3-year SONIA swap right down to, as you see on this graph on the left. And so we took the decision to fix our debt costs at that point, leaving us to make sure that we're not exposed to any further rises. And as you can see from the graph on the left, we're very pleased we did so, because the 10-year gilt today is at 4.5%, and spiking given some of the political events in recent days. So we're very, very pleased to be in the position of fixing our debt at that point in the graph. The additional scale that we've achieved since the debt was originally taken on allowed us to get a significant 47 basis point reduction in margin. And that causes a day one reduction in total rates down to 4.5%. As we take advantage of that reduction in margin, but keep out the swaps we had in place, rising to 5% as we get the benefit of the swaps, the benefit of that margin, and the new swaps we took out at that date. The debt now will has sustainability links included as well. Now, the cost of debt that we were seeing at the time at 5%, combined with our low LTV, which was previous refinance at 29%, and the pipeline that Justin had compiled and was looking at, prompted us to increase the size of that facility and release circa £50 million of capital to fund these EPS accretive acquisitions. Now, Justin's going to talk through the acquisitions in a moment, but the fundamental opportunity we were looking to take advantage of was that day one arbitrage between fixed cost of debt and the net initial yields that Justin could buy to the market. And crucially, we could fix that cost of debt, so we know where that is in the short term, through for the next few years. But also, Justin was buying asset management opportunities that allowed increased rental income to be generated through the asset management, meaning that arbitrage is there on day one and widens over the coming years. Looking at the full debt book, we have that on that top row. You can see that bank facility that we refinanced, bringing in some new banking partners to do that. It was a very competitive process, and we're really pleased to see how many people wanted to lend to us, moving debt books out of office, out of retail into logistics. But the remainder of our debt remains underpinned by fixed gilt-linked debt taken out at a time when the gilts were very, very low. So where that leaves us is £407 million of drawn debt at an ongoing cost of 4.15%, a maturity of 5.1 years, and an interest cover of 3.2x. LTV, still right at the bottom end. We guide to 30 to 40% LTV range, and we're right at the bottom end of that range still. So still very conservative, very robust, and with 100% fixed or hedged through to term, unexposed to interest rate shocks that we've seen in recent days. We know exactly where our interest cost is going to be. We know exactly, therefore, how we can drive earnings through the leasing side and the acquisitions and recycling. And with that, I'll hand back to Justin to talk through the investment and capital decisions we've made in the year.
Thank you, Jamie. As Jamie stated, our clear aim has been on executing against the plan that we set out to shareholders for our end-of-year results in March that we presented here on this forum in June. At the core of this was a strategy to rebalance the portfolio, as I said at the beginning, away from core and towards more asset management opportunities. Now, the core assets are typically lower yielding with lower growth rates, especially those where the rent reviews are linked to CPI or RPI, where you can't capture that market rental growth. The asset management opportunities we see, these are much more typically higher yielding opportunities with significant reversionary potential. Now, the aim of the strategy is to drive EPS to assist in achieving dividend cover. The acquisition program we undertook over the summer won't achieve it by itself, but it will achieve it in tandem with the leasing up of vacant properties and the asset management and capturing that rental growth Jamie's talked about earlier on the presentation. In addition, we believe the acquisition strategy also sets the portfolio up to benefit from capital growth as and when asset management is undertaken. So the first component of the strategy was to take advantage of what we saw as a dislocated capital market over the summer and invest the additional fixed cost debt that Jamie had secured and completed on at, I'll say it again, very advantageous rates, considering where the debt sits today. Now, the REITs acquired 45 million of assets with a net initial yield of 6.7% and a reversion north of 7.3% day one. So day one, that gives a fixed cost of debt arbitrage of around 160 basis points. Now, as I mentioned before, when we initially looked at this strategy, swap rates were around plus margin 5.75% fixed cost of debt. So that extra arbitrage Jamie has managed to secure via his refi has really benefited the day one arbitrage we're seeing on the acquisition pipeline. If we were to try and refi that today, I would say that cost of debt is somewhere between 6 and 6.25%, which in itself is going to start to hinder those debt-backed buyers in the market who are looking to raise debt against assets today or potentially refi in the near future. All the assets we acquired fundamentally had good credit, shorter lease terms, asset management and ESG opportunities to again rotate these buckets away from core and into asset management. Now, at the same time, coinciding with the return of the lower cost of capital coming into the market and returning back end of the summer in early September, be it UK institutions, family offices, private investors, we started to look into a recycling program. Now, post-period end in April, we disposed of around 3.8 million at a net initial yield of 5.3%. Post-period end in October, last week, we disposed of a further 7.7 million at a net initial yield of 4.85%. I think it's really worth spending a few seconds just looking at those two disposals because ultimately they were very similar assets. Both were good modern boxes let to good credit on 12-year leases with rent reviews linked to CPI. And you can see over the course of April through to September, almost a 50-55 basis point yield compression as that lower cost of capital came back and the outlook on interest rates and ultimately return hurdles has lessened. Now, I think it's this compression in yields has very much justified our sort of wait and see approach on asset recycling. If I was trying to sell either of those two assets in 2023, the only cost of capital that was in the market was US private equity, and they would have looked for a yield of around 6% to 6.5%. So as my CEO has often said, why would we sell our better core assets until the lowest form of capital has returned to the market and is back acquiring again? Now, just drilling into that acquisition program a little more, the way we set it out in June, we executed it quickly and efficiently. From the completion and certainty that Jamie gave me from his debt refinance in August, we transacted on 5 individual asset acquisitions within 5 weeks, with almost 90% of that being one-to-one off-market acquisitions. Again, focusing on that net initial yield of 6.73%, the reversionary yield of 7.32%, low unexpired term of around 4.5 years, and all the credit strong. The last asset we actually completed on, I think, is a very good example of our approach to risk and our ability to asset manage. We exchanged upon this asset in Dunstable vacant, so we bought it at a VP capital value per square foot. And in between exchange and completion, we secured a new 15-year lease by poaching a tenant from a nearby institutionally owned industrial estate to put into this unit. So from day one, it started to throw an income yield to the REIT of 7.1%. Now, people often ask us what our ideal sort of acquisition is. And I think Doncaster, which is one of the assets we bought over the summer, is a very good example of where we're willing to take risk in an undersupplied market and be creative in our acquisition approach. Now, this was acquired in mid-September for 11.695 million. It's 130,000 square foot, half a mile from Doncaster town centre, right on the road and motorway junction. We acquired it vacant from Syntner PLC, who'd occupied this since 2009. It was built in 2005 and effectively used as a sort of car supermarket. So fundamentally, the shed has not been knocked around for a more sort of heavy manufacturing use. It was in very good condition. Current EPC on it was a C. We have CapEx in the budget to improve that up to a B. The attraction here was buying off Syntner Motor Group PLC, who ultimately didn't want this on their balance sheet. Now, we were happy to take leasing risk on this, and so agreed an 18-month rent, rates and service charge agreement So we would take leasing risk, but the REIT from day one would benefit from a net initial yield of around 7.5%. Most interestingly, the rent we underwrote this acquisition off was at £7.25 a square foot. And as we stand today, 6 weeks later from completion, we're under offer to a 5A2 covenant for a 10-year lease at a rent of £7.95 a square foot. That's a 10% uplift on what we initially underwrote the deal at. Now, putting that into yield terms, on completion of those legals, the net initial yield off the current valuation price would sit at around 8.26%, which again, heavily accretive to the overall REIT. More importantly, if I look at the capital market, 10-year income in this sort of location today is trading around 6% income yield. So that gives the potential capital value uplift of around £2.5 million, or potentially a 20% capital return within 6 to 7 weeks of acquiring the asset. Now, on the one hand, we've been acquiring in the summer. On the other hand, as I've talked about, asset recycling becomes the cheapest form of capital with which to fund. A key function of this disposal program, as I've said, is to sell low-yielding dry income where rental growth is limited by CPI or RPI. Now, anybody on this call who attended our Capital Markets Day will remember touring Anglian Water in Peterborough, a very modern, fit-for-purpose shed. This is asset, I'd say, is a prime example of our approach to acquiring, asset managing, and exiting real estate, cradle to the grave sort of stuff. The site was acquired in June 2020, and we speculatively funded it vacant with a developer to a fixed term price. So we took no cost price on this or time risk, purely leasing risk. The REIT leased this to Anglian Water for a 15-year term with a 5-year rent review cycle linked to CPI 2% and 4%. In September of this year, as we saw that core institutional low cost of capital coming back, we sold it at a premium of 2.1% to the September valuation we've just published at a net initial yield of 4.85%, well below the dividend yield we're currently offering and also below the cost of finance. So as Jamie said, our lowest cost of capital currently is asset recycling of low yielding assets. The proceeds of this will be used to reinvest back into the type of asset management stock I've talked to you about on the previous slides, targeting yields in excess of 6%, shorter income, asset management, ESG improvement, and strong reversions. Now, to put our activity into the context of the market, you've probably heard from a number of our peers that it has been a more challenging leasing environment out there, with deals taking longer to do and decision-making somewhat protracted. Understandable in a year such as 2023, when the macro weighed heavily on occupiers' minds. If I look at 2024 year to date, the market statistics suggest a functioning leasing market. We've seen improved take-up compared to 2023, and now more businesses are willing to commit to space in a more stabilised macro environment. There is improved consumer and business demand. Nearshoring, continued online penetration, continue to drive areas of demand. If I witness the last 48 hours, say with the US election, do I think that nearshoring and onshoring here in the UK in the face of global protectionism is going to increase? I would say that's a fairly safe assumption to make going forward. If we look at the headline vacancy rate, and I use Savills statistics here, it's around 7%, but a lot of that is heavily influenced by this 2023 speculative development programme that was undertaken, which in itself is now being let up, and development starts are starting to slow. So effectively, the demand-supply imbalance starts to move into equilibrium. Therefore, general forecasters such as Savills are suggesting that the vacancy rate in 2025 will begin to fall as this development cycle lets up. Now, if we drill a little further into the detail, we can see the market for our size range of last mile mid boxes, typically 20,000 to 150,000 square feet, is functioning better, given its more needs-based demand. If you look at the bar chart on the bottom left-hand side, which is CBRE data, you can see almost 45-50% of all the deals for the first half of the year were in our space of the market. The range of occupiers has remained diverse. We continue to see new entrants come into the market in areas such as services and leisure to complement existing demand from manufacturing, 3PL, food, pharmaceuticals, and infrastructure. We talked in June to you about a barbell effect in the leasing market, where effectively tenants were focusing on their last mile fulfillment of circa 20,000 to 150,000 square feet in conjunction with their national distribution strategy, or big box to you and I, of 500,000 square feet. And it was this middle ground of, say, 300,000 to 400,000 square feet that we talked about, where we were starting to see an oversupply coming through. Back in, when we talked to you in June, there were 24 buildings of between 300,000 and 400,000 square feet, either coming out of the ground, available, or had been speculatively developed. Today, that's around 34 buildings. So you can see where that middle space, that middle ground of 300,000 to 400,000 square feet is weighing fairly heavily on the overall vacancy rate in the UK. Now, if I turn to the capital markets, they've continued to operate, and a lot of our peer group do our marketing for us. The main focus for investment is focused upon last mile logistics, and that remains a key focus in the UK capital markets for both domestic and overseas capital. Circa 2.6 billion of UK logistics has been transacted in the first half of 24. I continue to see that going forward in the second half. I've actually found the second half of this year far more interesting, as we've seen improved liquidity and the depth of buyers on deals has improved, with a range of risk requirements and return hurdles. A key feature I mentioned in June, and that we've seen continuing through into Q3 and we anticipate Q4, is this return of the low cost of capital. UK institutions, private investors, private family trusts. These are typically looking for lower ungeared returns and are typically targeting those more core assets that we are now prepared to start to rotate out. In addition, we've seen private equity starting to make large bets in the private and also listed market. Aberdeen Property Income Trust, a portfolio we know incredibly well, having had a look at it earlier on the year, it's been sold to Golden Tree. Tritax Eurobox is under offer to Brookfield. Project Tiger, which is effectively the Rothschild sale of the Charles Street Building Group, acquired by Lone Star for around 560 million. And BCPT, another listed entity, under offer to Starwood for 670 million. Now, this says to me that the private equity is starting to put large cash bets down on diversified portfolios, but with heavy industrial weightings to them. The pricing they're currently paying for these opportunities is low single-digit figures, discounts to the prevailing NAV. So the question is the quantum of capital being put down by private equity at the moment them calling the bottom of the market? If you take a couple of the deals like Project Tiger, 561 million had over 2.5 billion of capital chasing it. So private equity is looking for a home, and again, it is looking for a home in the industrial sector. Now, when I look at that in conjunction with the stable valuation market we've witnessed for the last 6 to 12 months, if you take the prime yields from the major valuation houses of Savills, Knight Frank, Jones Lang, and CBRE, you can see that a picture is emerging of a broad spectrum of domestic and global capital chasing a sector continuously attracted by its fundamentals and the ongoing rental growth it is seeing, albeit coming down to a more normalized level of an inflation plus 3 to 5% per annum over the next 5 years. Now, I think a lot of the effects of the deals I'm seeing in the market today, for instance, we bid on an asset last week with a net initial yield of 6.5%. Asset was driven down to 5.75%. So we pulled out of that deal, not a deal that I want to be buying off today, but it shows the depth of demand in the market and where we potentially see the market driving yields going forward. So effectively, the capital market is functioning. There is capital. It is very focused on quite narrow sectors, such as the industrial and more specifically the last mile logistics. And we do anticipate that capital to continue. I think it is far too early to comment on what is going to happen given the volatility we've seen, as Jamie mentioned, in the 10-year gilt and the debt rates in the immediate aftermath of not only the UK budget, the US election, but also this morning, the interest rate cut by the Bank of England of the overall UK interest rate. I'm going to bring the presentation down to its final summary now and really run you through what our strategy has been. In half one, it really was put the balance sheet to work. Provide the certainty to the market of the debt refinance, which again, given where you've seen swap rates move to, I think is at a very interesting and advantageous level to us, especially given it allowed us to draw a further 45 million down to fund assets at a fixed rate cost of debt at 5% and produce income assets at 6.7 with reversion north of 7. The second half of the year we're looking for, we've sold assets at a 4.85 initial yield. We've got further asset sales that we're considering at the moment, again, closer to that 5%, where we see the income arbitrage to be able to reinvest back in north of 6.5 to 7%. As Jamie talked about earlier on, there is further reversion in the portfolio. 27% is the highest level of reversion we've had since IPO. We are looking to capture this growth. We've undertaken asset management events. We continue to try and improve income and grow that income going forward. There are 2 vacant assets we put under offer post-period end, and they're potentially adding a further 1.8 million in annual rental income. So where do we sit as a strategy? Well, from a top-line level, we're in the right sector. In real estate, that is incredibly important. Secondly, we've got a clear growth plan. We have a clear strategy to access, asset manage, and capture the reversion that's already pregnant in the portfolio, and then improve capital value via the asset management of those assets. We have a highly experienced management team with decades of experience who are purely focused on the REIT and the improvement and EPS of our income yield. We believe with almost 1.15 billion of assets and a platform as it currently sits, we have a really good opportunity to grow the balance sheet going forward, which, as Jamie has already hopefully outlined to you, is an incredibly safe and secure position. So all in all, as we put our interim results out today, we feel well positioned for growth. We believe we've got the platform to do it and the management expertise to undertake it. So I thank you very much for your time this afternoon, and I wish you a good day.
Perfect. Justin, Jamie, if I may just jump back in there, and thank you very much indeed for your presentation this afternoon. Justin, perhaps before really just looking to redirect those on the call to provide you with their feedback, which I know is particularly important to yourself and the company, if I could please just ask you for a few closing comments to wrap up with, that would be great.
Certainly. Almost echoing what I previously just did, it's the right sector. It is a sector that is attracting a lot of global and domestic capital. The low cost of capital in the market institution is coming back, and that will allow us to enact upon our strategy of asset recycling. We have a very strong balance sheet, so we're not forced to go into a market and sell assets. We have a good level of reversion coming through that we'll capture via lease renewals, rent reviews. And going forward, the market fundamentals of a low-cost CapEx model that last mile logistics is, coupled with continued rental growth going forward, we believe will be in a very attractive space for investors to sit in the medium to long term.
Perfect. That's great. Justin, Jamie, thank you once again for updating investors this afternoon. Could I please ask investors not to close this session, as you will now be automatically redirected for the opportunity to provide your feedback in order that the management team can really better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of Urban Logistics REIT PLC, we would like to thank you for attending today's presentation. That now concludes today's session, so good afternoon to you all.